Welcome, ladies and gentlemen. Today is December 3rd, Saturday, and this is the TTScanner Hotlist video. My name's Brad Matheny, and we're going to go ahead and get started. Now, I want to talk to you about what's actually going on here, and I think it's a fairly exciting time in the market overall. There's a ton of people out there that really believe that the markets are going to collapse and that the world's going to end, and I just don't see it that way. I see this is the biggest opportunity of your lifetime. It really doesn't matter, in my opinion, what the markets do, whether they collapse to 2008 levels or they continue to move higher. What I do believe is that global central banks and general trader psychology want the market to try to recover, stabilize, and move forward, move upward. Now, I also believe that this is the most unique time in history. We have never had a time like this other than after World War II, where we entered into a period of malaise, where money had been spent, we had gone into extreme debt, and that money, we were what, 102% or 110% debt to GDP ratio. And we had ended a global destruction process between Japan and Germany and what had taken place with the war across the world, really. But we entered into a 15-year stagnation period in the 40s and the 50s and the 60s before we started to see some real growth. And it really started happening after the 50s and the 60s, when everything stabilized and we moved into a new economic impulse period, meaning we recovered from the war, we rebuilt. The concerns of the global economy in Japan and Germany and Poland and Europe had been rebuilt. We entered into a period of safety and complacency and focus on growth. And during this period, we had the rise in advanced technology. Remember, in the 50s, if some of you may remember, I wasn't around in the 50s, but I was in the 60s. But anyway, long and short of it, we had increases in technology, we had increases in infrastructure, we had increases in industry, we had new industry like airlines and electronics and you name it. I mean, the world was a dynamic place in the 60s, 70s, 80s, and 90s. Very, very dynamic for a 40-year time frame. What I believe has happened since the 2000 dot-com bubble burst and the 2008-9 global financial crisis is we've gone through a period of somewhat similar to an extended World War II. So imagine 9/11 attacks and the dot-com bubble burst in 2000 and 2001 entered us into an extended period of market malaise. Then almost like a war, with somewhat destructive, unknown economic forecasts. And over that time frame, we had the U.S. global financial crisis in 2008, 2009, which was then a broader unwinding event, almost like a financial war that took place globally. And we recovered from that. We went deeper into debt. We put more money into the economy. The global markets entered into a period of approximately 8 to 10 years worth of rebuilding, restructuring, and taking on debt, building infrastructure, building new technology, building capacity, increasing GDP, and really kind of a recovery phase. Let's say from 2012 to 2021. Now we're seeing a bit of an unwinding phase, which has taken place because of the Fed raising interest rates and sending the global markets into a bit of a contraction. Okay, but in reality, what we're doing is we're unwinding excesses. Okay, and that's very solid, almost very similar to what happened after the 1971 to 73 end of the gold standard. We had ended the gold standard, we increased our credit, we went into a kind of an excess phase, and then in the 80s, we got the extreme inflation. We unwound some of our excesses, and then we moved into an 80s, 90s phase, consolidation, unwinding excesses, and moving into kind of a growth phase. It was a moderate organic growth phase. And that's kind of where I believe we're at right now. I believe what took place from 1935 to say 1980, which is a 50-year time frame of going through these excesses of war, consolidation, rebuilding, consumer strength, rebuilding consumer strength after the war, and then having the excesses of the 1970s, end of the gold standard, take place and transition through the 80s inflationary period into a more organic growth phase in the late 80s, early 90s. I believe that entire thing has taken place over the last, essentially, let's call it 18 years. So it's about 1/3 of the time it took from 1935 to 1970, 80. I believe from roughly 2000 to now, which is about 23 years, has taken, so that's about half the time. Now we're into a period where the next 5 to 6 years could be really solid organic growth before we move into a 2029, 2030, 2031 crisis phase, which will then move us into an expansionary phase, which is going to be unprecedented for about 20, 25 years. So we have between now, 2022, or let's call it early 2023, until roughly 2029, 30, to prepare for what could be some of the biggest and best trends in the global markets that we've ever seen. Now, by 2029, 2030, we need to move into a different stance, and I will keep you abreast of that as we get closer to it. But the reality is, a crisis event will likely take place between 2029 and 2031, 32, which will set up the biggest, most expansive growth phase in global market history between 2033 to 2042 roughly. And that's going to be really incredible. Now, where we're at right now, if you follow my research and you watch my other videos, you'll learn that we are seeing early growth stages in the custom index charts, showing that we may be moving into a melt-up phase through the end of 2022. But we still have to be very concerned with regards to volatility, unknown events taking place, and the potential that we could have a 5 to 7% reversion downside move between now and, say, the end of January as we try to settle the end of 2022, Q4 2022 expectations. So I expect a melt up in the market, but we still have a lot of concern with regards to a potential 5 to 7% downside reversion trade, which may still be in the cards. We can't get very aggressive yet. We are seeing accumulation. This is the new TTScanner Hotlist. We are seeing accumulation and bullish trending. Remember, a few weeks ago, this was all red. Bearish, 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 bearish. And what is changing? Look at this. Healthcare is changing. Financial services is bullish. Raw materials, global technology is bullish. Healthcare, gold miners is bullish. Energy has gone back to bullish. Aerospace and defense. So different sectors, really banking, financial services, are moving very strongly to the upside, or at least moving in an upward trend, which is substantial. Okay, we may see the U.S. markets move into a solid melt up fairly soon, meaning continue to melt higher. S&P or the SPY may be up at 435 to 440 before the end of the year. I know that a lot of people believe the markets are just going to collapse. I don't see that happening. I see a moderate melt up with some moderate volatility going forward over the next 35, 45 days. But I believe a melt up is in the cards, guys. I believe it's just going to continue to melt upward in the U.S. markets because the U.S. markets are not the foreign markets. We are still, the economy is strong, consumer is strong, financial services are doing well, earnings are still fairly strong. What we need to see is the consumer come back in, start driving purchasing, and I believe that may happen through Christmas and through Q1 of 2023, depending on what actually takes place with the Fed. But again, looking at the hot list, we've only got 3 triggers. They're older triggers here on this hot list. So I'm going to ignore the rest of this, but I want you to focus on these green accumulation triggers as we look through the next couple of TTScanner hot lists. We're starting to see trends move back to the upside. This was all red 2 weeks ago, even last week. But now they're starting to move back into bullish trending. We're starting to see some upward trending. We need to be cautious, though. Follow the rest of my research. Follow my rotational modeling system updates and my custom index updates. This is not the time to get aggressive and start diving into these triggers. This is the time right now to stay cautious until we get a real solid confirmation. Okay, now the next one is the value hot list. A couple of good trades here in the value hot list. Now, I'm going to move this into, I'm trying to make this wider so everyone can see. And what we're going to see here is these new trade triggers from last week. So these were new triggers last week. IBM is up 0.47%. We have McDonald's Corporation is down 0.54%. We have T-Mobile is up 0.93%. And we have Walmart is up 0.33%. So far, these triggers are holding up, okay? Moderately flat, moving higher. This trigger was from 2 weeks ago. Smucker's is up 7.49%. Lovely move over 2 weeks. It's already hit target 1. We had our entry price of $143.69. We're currently at $154. Gotta love it. Thrusting is positive. Access with our win rate and our profit factor shows we should probably be about 30 or 40% allocation in this trade. CMI Cummings is up 0.54%. It's been in the trade for about 2.5, 3 weeks. Haven't really reached any targets yet. Holding its own, but not moving strongly higher. Amgen is up 6.47%. It's been in the trade for 3.5 weeks. We've already got a beautiful trade target at $291.95. That is, again, about 8.5% target on that trade. Moderate upward thrusting, and again, we should be about 30 or 40% in the allocation on this trade. MRK, Merck and Company, is up 11.72 over 3.5 weeks, 11.72%, already hit the first target. Very solidly up. Let's see, entry price is 98, 105. So that's going to be about a 6.5% target. And next is PFG, is long, 4.5 weeks in the trade, up almost 5 or 6.5%. We've already hit our first target. That's going to be about a 6.5% target as well. And then lastly, we have one here, which is come across Travelers Company is up 4.19% and has not hit any targets yet. We have this one up here, Hasbro, which was a short from 7 weeks ago. It's up 8.7%, and it's already hit its first target. So the point behind these, ladies and gentlemen, is these are swing trades, weekly swing trades. These are designed to allow you to capture great setups and bigger swings. Now, understand that when we get into longer-term swings like we have here, 54% profit, 43% profit, then Chevron and United Health. These are 47 weeks and 85 weeks old. These are long-term swing trades. When we get back into that mode where we can be aggressive, when the rotational modeling system is telling us we can be aggressive, or the other custom indexes are telling us we can be more aggressive, then we're going to be able to start deploying capital more efficiently with our trading, okay? We're going to be able to capture these bigger moves. Right now, we're trading a very small amount of our capital. The rest of our capital should be in cash and or metals to protect us. Metals, of course, have been up. They're going to continue to go up. I've been warning you guys about this for months, actually years. But long and short of it, what we're looking at right now is we're starting to see bullish accumulation. The indexes are changing. These stock sectors are changing back into bullish trending. And we're starting to get some good solid triggers, which are carrying through into targets. Now, given where we're at with these targets and given where we're at with the market, whatever you decide to allocate, and I've gone through this talking about the profit factor and the win rate, how with a strong profit factor and a strong win rate, you could allocate more. With a weaker profit factor and a weaker win rate, you should be allocating 25, 30, maybe 40%. When it's very weak, let me find something that's very weak. So like here, 30 and 70, this is something that you should probably be allocating 15, 20% to. When it's strong, 1.0 or 2.57, you can be 75, 80, maybe 90% allocation. Here's a great strong one, 2.16 and 5.67. This is definitely 80, 90, 100% allocation, or this one. But when they're mixed, this is where you have to kind of play in. Like 1.05, 2.86, to me, that's 60, 50, 60, 70% allocation. 1.23 and 2.86, this would be 60, 70, 80% allocation. 0.67, 1.45, this would be 50, 60, 70. Again, this would probably be 50, 60, 70, maybe 80. 0.51 and 1.23, this would probably be, 40, 50, 60. Same thing here. 0.56, 1.0, this would be 40, 50, 60. Where it starts to get negative when I get into like this, 0.47, 0.92, this should be 30, 40, 50. Same thing here. This should be 30, 40, 50% allocation. So you have to determine how you want to allocate your capital based on what you're seeing with these numbers. This Hasbro, well, I mentioned it to you when we got into the trade, had a very low profit factor and a very moderately low win rate. So this would really be, 15, 20, 25, 30% allocation. I wouldn't go more than 30% with something like this. And again, here's another one. I wouldn't go more than, say, 30, 35% with something like this. The only reason I'd say that this is slightly higher is that actually it's the same. So really, I wouldn't go much above 30% with this. But we're getting good triggers. And that means the markets are starting to trend again. They're starting to potentially move in an upward scenario, upward trending, and that means we could see a flood of new buy triggers if this continues to melt up. Remember, we're staying conservative with our allocation levels because we don't want to bet the farm right now on something where we could see a downside 7, 8, 10% move and watch 10, 20% of our portfolio break down. Now, I'll give you an example. A lot of hedge funds right now are going to be end of the year looking at very poor results. And you can probably see that in your retirement account if you've let it set. Minus 15, minus 25, minus 35 or more % downside moves because of this move in the U.S. markets. A lot of people have gotten very, very aggressive and continue to try to bet the farm on what's going to happen next. My opinion is we need to stay conservative, protect our capital, and wait for the markets to give us the opportunity to become more aggressive, which it looks like I said, because of these bullish triggers, we're starting to move into more of a consolidated bullish trend. Okay, next we're going to go to the core and the core inverse setups. So now the core, this is the core inverse, and we have one new trigger, SDOW. From last week, it's up 3.01%. We have a trigger that went flat, TMV went flat, and you can see we have some longer term triggers. We have ERY, which is a short, which is minus 0.80 right now, and that is our only other trigger on this chart. You can see this is the inverse. So this is essentially in a down market, this would be producing bullish triggers here. We're now in a moderate upward trend. It's showing distribution and bearish. So what's going to happen here is we're likely going to start to get quite a bit of short triggers here over the next couple of weeks if the upward trend continues. Lastly, we will go to the core list. This is the TTScanner core list. We have no new triggers. We have actually a bunch of older triggers here. They're up, this is 29 weeks, 30 weeks, 33 weeks, 42 weeks, and 46 weeks. They're up quite a bit, 18.4, 27.5, 5.6, 33.1, and 46.89. We're going to be looking for some new triggers. Notice the bullish coming back in here. This is what I was telling you. We're starting to get really moderate mixed signals. And this is telling us the market is seeking to move into a new trend. Take a look at my custom index video. It is fairly long today, but it is important for you to understand what's happening. And take a look at the rotational modeling system and real estate video while you consider what we have here with the TTScanner Hotlists. What we're seeing, ladies and gentlemen, is the U.S. market is moving into an apex flagging formation just before Christmas, just before the holiday low volatility and low volume season kicks in. I expect a moderate melt up to continue to take place. I expect a 2 to 10% volatility range to take place between now and January 15th or 20th. So that means we're going to have a moderate melt up with possibly a 5 to 7% rotation range, maybe a bit more. I expect this is not the time for us to become aggressive. I expect this is the time for us to sit safely, protected in cash, waiting for the markets to move in a direction that will allow us to deploy more efficiently. And the one caveat that I would add to that, or the two caveats or exceptions that I would add to that, is that metals are moving just as I expected into another expansion phase. The next upside target for gold is going to be above 2,000. I'm really thinking it's more along the lines of 2170, maybe 2180. And then we'll maybe stall out just below 2200. And then a few weeks, maybe into February, March, we'll start to see it rally again. But the other thing is that technology and innovation sectors seem to be fairly solid right now for dipping your toes in. So I'm going to come back over here, and I want you to see here, construction, healthcare, select spider trust technology is bearish, financial services, global technology is still bearish, healthcare, miners, natural resources, energy, healthcare, iShares technology ETF, IBB is bullish. Secondary bank shares, ultra short QQQ is bearish. The US iShares technology ETF is bearish. The one thing that's kind of important, and let me come back over here, and find it. Come in here and here. Okay, the FANGs index has moved very solidly into a basing bottoming formation right now. There still is a bit of risk. I'm mentioning this to you. I mentioned it to you last week and the week before that and the week before that as we got down here near this deep bottoming low and back over here in this area. This has historically been a very solid basing bottoming formation for the technology sector. This is very low. We could see it roll back lower again and retest these areas before the end of the year. But barring some kind of a catastrophic event, this lower area is very solid basing and bottoming for the technology sector and the FANGs index. I do not recommend taking a blow the socks off position in this. I expect and have already started taking early stage dipping my toes in the technology sector, particularly in some March call options and some Tech L positions, options as well, looking for a reversion back up here into this upside area. So it would be like 159, 165 from where we're at right here, which would essentially be a 20 to 25% upside move. But I want you to understand there are still opportunities. Just be aware that you do not want to bet the farm. You don't want to go crazy. You don't want to be loading up on options or loading up on your positions right now. We have a very solid chance we're going to get a melt up. The markets look like they're moving in an upward trending. They're trying to flag out and try to break into a moderate melt up through the end of the year and into Q1 2023. So again, we're getting some very good signs of a potential melt up, but I cannot advise you to go crazy and go, bet the farm on anything. The logical scenario here is that early stage, moderate positions in some undervalued sectors could be very solid. For example, oops, wrong one. Try to get back to where I want. Did I lose it? Actually, no, it's this one. So this alternative MJ and ARC and these others on this core list, they're going to start to flip back up to the upside. And I believe these beaten down alternative sectors may be poised for a decent rally in the first half of 2023, maybe even further. I believe gold and silver and miners are really going to start to perform over the next couple of years. And I believe, like I said, this is a fairly good time to maybe move into some early stage, small allocation, dabbling in some of these beaten down sectors. And again, it may be that it's still a bit too early, but I believe we're seeing strength in the financial sector. We're seeing strength in consumer staples. We're seeing strength in metals. We're seeing strength in custom index charts. I believe we're at a transitional phase here where we could see a moderate reversion. As I indicated back over here with the FANGs index, I really believe we're going to see a move back up into this area as a reversion trade into Q1 2023, which would be a 15 to 25% reversion to the upside. Would still be well off of the highs, ladies and gentlemen. And then from there, we may flag out in 2023 before attempting to find a new trend, which may be back to the upside. I'm still calling this a wave 5, start to wave 5. This is our wave 4 down, A, B, C, D, E, wave 4 correction. Now we're going to start a wave 5 move up, which will start with the impulse wave to the upside, which will likely be an ABC or ABCDE type of move. And I believe it's going to end right around this reversion, 180 to 210 area, right below this area, stall out, flag down a little bit, find support, and then begin to move higher in the second half of 2023. All right, guys, that's kind of it for now. Sorry I've gone on so long. Share my research with your friends, please. I'm trying to help you out. I'm trying to keep you abreast of what's going on. And like I said, I'm amazed at all the doom and gloomers out there. I mean, I don't want to say it, but I watched some comments last week that were just frightening, literally frightening. And the comments on Twitter from people who had bet the farm on these positions and then lost the farm was just frightening. I mean, follow along. It's not that hard. There's tons of time left to try to make money in the markets, and we just need to protect the capital we have and move efficiently when the markets give us opportunity. So share this with your friends. Tell them about what I'm doing. Let me know how you're doing and what I can do to help you improve with everything that's going on. All right, guys. Thanks a lot.